At Confidence Wealth Management, we got many people asking us, what is the Secure Act 2.0 that just got passed in December? You see, Secure Act 2.0 has significant changes to the way Americans save for and tax in retirement. Keep watching to learn more. You see, big changes are coming for Americans' retirement savings. The changes, part of the Securing a Strong Retirement Act, better known as the Secure Act 2.0, were included in the sweeping end of year 1,650 pages, $1.7 trillion omnibus spending bill. So, what does the legislation do? The following is a brief summary of some of the most notable initiatives. All provisions take effect in 2024 unless otherwise noted. Later age for required minimum distribution, also known as RMDs. The 2019 Secure Act raised the age at which retirement savers must begin taking distributions from their traditional IRAs and most work-based retirement savings plan to 72. Secure Act raises that age again to 73 beginning in 2023 and 75 in 2033. Reduction in the RMD excise tax. Current law requires that those who fail to take their full RMD by the deadline to pay a tax of 50% of the amount not taken. The new law reduces that tax amount to 25% in 2023. The tax is further reduced to 10% if the account holder takes the full required amount and report the tax by the end of the second year after it was due and before the IRS demands payment. No RMD from Roth 401k accounts. Bringing Roth 401k and similar employer plans in line with Roth IRAs, the legislation eliminates the requirement for savers to take minimum distribution from their work-based plan Roth accounts. Higher limits and looser restrictions on qualified charitable distributions from IRAs. The amount currently eligible for qualified charitable distributions from an IRA, $100,000, will be indexed for inflation. In addition, beginning in 2023, investors will be able to make a one-time charitable distribution of up to $50,000 from an IRA to a charitable remainder annuity trust, charitable remainder unit trust, or charitable gift annuity. Higher catch-up contributions. The IRA catch-up contribution limit will be indexed annually for inflation, similar to work-sponsored catch-up contributions. Also, starting in 2025, people aged 60 to 63 will be able to contribute an additional minimum of $10,000 for 401k and similar plans, at least $5,000 extra for simple plans each year to their work-based retirement plans. Moreover, beginning in 2024, all catch-up contributions for those making more than $145,000 will be after-tax Roth contributions. Roth matching contributions. The new law permits employer matches to be made to Roth accounts. Currently, employer matches must go into employees' pre-tax account. This provision takes effect immediately. However, it may take some time for employers to amend their plans to include this feature. Automatic enrollment and automatic savings increases. Beginning in 2025, the Act requires most new work-sponsored plans to automatically enroll employees with contribution levels between 3% and 10% of income. It automatically increases their saving rates by 1% a year until they reach at least 10%, but not more than 15% of income. Workers will be able to opt out of the programs. Emergency savings accounts. The legislation includes measures that permit employers to automatically enroll non-highly compensated workers into emergency savings accounts to set aside up to $2,500 or a lower amount that an employer stipulates in Roth type accounts. Savings above this limit and any employer matching contributions would go into the traditional retirement account. Matching contributions for qualified student loan repayments. Employers may help workers repaying qualified student loans simultaneously save for retirement by investing matching contributions in a retirement account in the employee's name. 529 rollovers to Roth IRAs. People will be able to directly roll over up to a total of $35,000 from 529 plan accounts to Roth IRAs for the same beneficiary, provided the 529 account have been held for at least 15 years. Annually, the rollover amount would be subject to Roth IRA contribution limits. New exceptions for the 10% early withdrawal penalty. Distributions from retirement savings accounts are generally subject to ordinary income tax. Moreover, distributions prior to age 59 and a half also may be subject to an early withdrawal penalty of 10% unless an exception applies. The law provides for several new exceptions to the early withdrawal penalty, including an emergency personal expense, terminal illness, domestic abuse, to pay long-term care insurance premiums, and to recover from a federally declared disaster. Amounts, rules, and effective dates differ for each circumstance. Savers match. Low and moderate income savers currently benefit from a tax credit of up to $1,000, $2,000 for married couples, filing jointly, of course, for savings in a retirement account. Beginning in 2027, the credit is redesignated as a match that will generally be contributed directly into an individual retirement account. In addition, the match is allowed even if taxpayers have no income tax obligation. More part-time employees can participate in retirement plans. The Secure Act of 2019 required employers to allow workers who collect at least 500 hours for 3 consecutive years to participate in retirement savings plans. Beginning in 2025, the new law reduces the second component of that service requirement to just 2 years. Rules for lifetime income product in retirement plans. The Act directs the IRS to ease rules surrounding the offering of lifetime income products within retirement plans. Moreover, the amount that plan participants can use to purchase qualified longevity annuity contracts will increase to $200,000. The current law caps the amount at 25% of the value of the retirement accounts or $145,000, whichever is less. These provisions take effect in 2023. Qualified annuities are typically purchased with pre-tax money, so withdrawals are fully taxable as ordinary income. Withdrawals prior to the age of 59.5 may be subject to 10% penalty tax. Retirement savings lost and found. The Act directs the Treasury to establish a searchable database for lost 401k plan accounts within 2 years after the date of the legislation enactment. Military spouses. Small businesses that provide immediate enrollment and vesting to military spouses in an eligible retirement savings plan will qualify for new tax credits. The provision takes effect immediately. These provisions represent just sampling of the many changes that will be brought about by the Secure Act 2.0. In the weeks ahead, we'll provide additional details and an in-depth analysis around the legislation key provisions and how they will impact you. If you have any questions, feel free to reach out. Our contact information is in the description.